Picture this. You're sitting at your trading desk, charts are in front of you, and you're about to dive into the intricacies of the Forex market, particularly focusing on the euro-dollar pair. You're probably asking yourself, how do the pros do it? How do they review the market to optimize their trades? Well, you're about to find out. Hi, I'm Oliver Cooper, the spokesperson for StarseedFX. The in-depth analysis you're about to witness has been meticulously curated by Mohammed El-Sayed, the driving force behind StarseedFX. If you're new here, a comprehensive, free course on smart money concept trading strategy is just a click away on our channel. Today, we're responding to a query from one of our community members about reviewing the market specifically for the euro-dollar pair. As traders, we know it's pivotal to accurately interpret the market structure before we even consider entering a trade. Let's embark on a step-by-step journey on how to decipher the current structure of the euro-dollar market. First off, I usually survey the larger picture by assessing the overall trend on the D1 and H4 timeframes. What is our current scenario for both timeframes? Bullish, my friends, bullish. Shifting our focus now to the H1 structure, we're met with the same bullish trend. What does this tell us? Simply put, it's safer to buy the euro-dollar pair than to sell it at this moment. This is due to the alignment of trends across all three time frames. But remember, the smaller time frames, such as H1, could show bearish trends despite D1 and H4 being bullish. About 10 days ago, there was a noticeable change of character on H1, indicating that the market had transitioned from a previous bullish trend to a bearish one. This could have signaled a forthcoming downtrend for the euro-dollar, or it could have been a mere pullback or retracement on the higher timeframes of H4 and D1. As it turned out, it was just a pullback, and the price swung back to a bullish change of character a few days later. Now that we know the euro-dollar is in a buying mood, the question is, how and when do we enter a trade? This is where our trading plan enters the scene. Step 1. Spot a break of structure or a change of character. Step 2. Look for liquidity. Step 3. Identify and mark the fair value gap. Step 4. Patiently wait for inducement to take shape. Step 5. Pinpoint and mark the order block or point of interest. Step 6. Once the price ventures into the point of interest, switch to a lower time frame such as M1 to M15. You'll be happy to note that we've already identified a change of character here, which is equivalent to a break of structure, ticking off step 1. Moving on to liquidity, we've located it right here, fulfilling step 2. For step 3, let's mark the fair value gap. Following that, in step 4, we need to play the waiting game for the inducement to form. Now, this level here is an inducement. How did we determine this? Because this bearish candle's low was surpassed, and the next candle also outdid its high. On to step 5. We'll mark our order block or point of interest here. At this point, we sit back and wait for the price to reach our point of interest. If you're an experienced hand and know what you're doing, you can find a counter trend set up to sell, at least aiming for this fair value gap. And that's it for today's deep dive into the Forex market. By following these steps, you can navigate the choppy waters of Forex trading, making informed decisions and potentially reaping profitable rewards. As always, please give this video a thumbs up if you found it helpful, and don't forget to share it with your trading friends. Hit that subscribe button to stay up to date with our latest insights, and do consider joining the StarseedFX community, where we continue to enlighten, educate, and grow together in our trading journeys. Remember, We're all about supporting each other to achieve our financial dreams. This is Oliver Cooper signing off until our next Forex adventure. Trade safe.